Well, the 10-year Treasury yield rising today as investors weigh the current economic outlook and new comments from Fed officials. Chicago Fed President Austin Goolsbee told the Wall Street Journal the Fed needs to monitor those higher yields to ensure they do not slow down the economy more than expected. The yield on the 10-year rising on the back of those comments from the Fed chair. We saw it rise above 5% last month. Since then, it has pulled back just slightly, but you see right now at 4.6%. Let's bring in our next guest, Eric Diton, the Wealth Alliance president and managing director. Eric, good to talk to you today. We're not at 5% anymore, at least on the longer ends. But the Fed chair making pretty clear today that he doesn't believe that where things stand right now are restrictive enough. Which camp are you in? Do you believe another hike is going to be necessary in order to bring inflation down to 2%?
Well, first of all, let's just talk about Jay Powell for a minute. Leave it to Jay Powell to ruin a great party. This was supposed to be the 9th day in a row that the S&P would have been positive, the first time in 19 years. Not meant to be. Now, I am in the camp that I don't think the Fed is going to hike again this year. Maybe we get one more hike sometime in the first quarter of 24. Bottom line is the bond market is doing some of the Fed's dirty work. And even though we've had a pullback in yields from 5%, we've had a big hike in yields on the 10-year looking back the last 3 months. So those higher rates on the long end basically take pressure off of the Fed to do more on the short end. So I'm not expecting any more rate hikes this year.
And Eric, I'm interested in your view of where the U.S. economy is and where it's headed. You know, we're heading to election year. 12 months from now, Eric, how do you see the U.S. economy holding up? You think we're the same, we're weaker, we're stronger? What's your outlook there?
I think, look, the trend is very clear. We're seeing prices come down. We're seeing wage hikes come down. The ISM, manufacturing index, slowing down. Higher rates do take a toll over time. We've been saying for a long time the Fed's medicine is working. It is. The economy is slowing, despite the strong 4.9 third quarter GDP, which was really due to a low savings rate. That was an anomaly. We're not going to see that in the fourth quarter. The bottom line is I see a slowing economy, but I do not see a recession. We've been talking about a recession now for a year. It hasn't happened. Labor market's still pretty tight, still hiring, still not enough workers to fill those open jobs. So I think with a 3.9 unemployment, I think we've got room, we've got leeway, and I think we could very well see a soft landing. That's the camp I'm in right now.
Eric, let's talk about how you're advising your clients in that environment. I'm looking through your notes here. I'm going to start with the very bottom of the list. You talk about small cap being a big opportunity right now. Is that just largely based on how far they've fallen and where valuations are?
Yes, we're really seeing small caps trade at very low PEs, very low valuations. By the way, I don't want to buy the Russell 2000. A lot of those companies are not profitable, but there are great managers out there, small cap value, small cap growth managers who have great track records. But this is a stock picker's market. In a slowing economy, small stocks are going to feel it more than large stocks. So you got to be careful. But I love the valuations. This is as cheap as we've seen in a long time, years.
And Eric, you also like, it looks like dividend stocks. What's your play there?
Look, buy low, sell high. Dividend stocks have really taken it on the chin this year. This is one of the worst years ever for utilities. We're seeing lots of great companies out there with strong balance sheets yielding 5% plus with histories of raising dividends. We're managing money for a lot of retirees. They need two things. They need an income and they need a rising stream of income to hedge inflation. And dividend stocks tend to do that. Bonds do not. So we like dividend stocks.
Finally, Eric, we started by talking about bonds. Let's talk about how to invest in bonds. Treasuries, private credit, what do you like right now?
I like them all. I really like municipal bonds. I think that over time, we're going to see tax rates increase. How are we going to solve these huge deficits? So tax-free bonds make a lot of sense. We're seeing yields we haven't seen since 2007. As a money manager, I am thrilled to see yield. I do like private credit. You got to be careful because it's kind of getting a little manic. And whenever I see everyone talking about something, I get nervous. But there are some great companies out there that have great track records in private credit. We're seeing yields 10% plus. That's very attractive. And there's an opening here. Regional banks can't lend like they want to because their balance sheets are hurting. And that's a real opportunity for other lenders out there.
Eric Diton, thank you so much for joining us today, Eric. Appreciate it.